and I'm glad that you mentioned that, there's no such thing as a free lunch. I have lots of YouTube comments that always are, claiming that, distributions are free money. I think sometimes they might not understand the strategies of a lot of these ETFs. So, obviously this is an actively managed fund. I know there's some flexibility for the fund managers to maybe deviate from kind of the general strategy that's outlined in the prospectus, including sometimes they're able to distribute more than they actually earned in the last month, and then sometimes they actually distribute less than they earned. So can you kind of talk about that and some of the options that they might have?
Yeah. So for us, we internally, and I guess to an extent externally, we kind of have an approximate distribution goal, right? And I don't want to say that because I don't want to marry us to that on a video, but it's effectively what we're paying now, right? And so our view is that based on the type of the risk profiles in the market and the opportunities in the market, we think we can effectively pay out, sustainable dividend yields, right? The problem is sometimes that, life doesn't happen in a straight line, right? And so, it would be very convenient if, right now we're paying out 30 cents a month and have done so for a while, right? Mm-hmm. In a perfect world, we're generating 30 cents of income every month and then paying it out exactly, right? But we know that, again, the path to success is often very jagged and, rosy curveballs, right? So some months you might generate 40 cents and other months you might generate 10, or you might lose 5, right? And so for us, we have to look at this and say, okay, do we think over a long-term period, right? Let's call it, the next 12 months, the dividend or distribution amount that we're paying is sustainable given the market structure and, again, where we think we can get return. If it is, we continue paying it. And we assume that, some months you're going to be paying fully income. Some months you might have a little bit of ROC just to make sure you're kind of keeping up, right? If we saw substantial return of capital, or let's say we were overpaying our distribution for a very long time and saw, again, ROC for a very long time, we would probably reassess that distribution and go, okay, maybe we should lower it to be a little bit more sustainable, right? And the goal, we want to be a sustainable dividend product, but we also want our NAV or our price to stay kind of, stable as well, right? So if you were to look at our price or our NAV and see it bleeding lower and lower and lower, that would tell you that we are probably, paying out more than we should. And so if you look at SVOL on a price basis, and we get this question a lot, back when we launched the fund in 2021, we launched at $25 a share. We did not pay our first dividend until September of 21, and that was a pretty smooth period for the strategy. And so you're accruing a lot of income, getting up to around $27 or $28, right? As we start paying out our distributions, which then come out of the NAV or the price, right? So you see, when you pay a distribution, you go ex-div, you see the price drop, right? As we start paying the distribution, we also then enter a market where vol starts to go nuts, and technical term, right? And you see, some downside pressure in SVOL. So that is a short-term period where, okay, we're losing on our trades. We're also paying out a dividend, and we have to say, okay, is this sustainable? Well, sure enough, a few months later, kind of get through that market, and you start to see the NAV stabilize and eventually start to kind of accrue back up. And if you look at SVOL's price NAV, over the last really year plus, we've pretty much been sitting around 22 or 23 bucks.
Right.
Right. And so, again, as I mentioned earlier, anytime you're looking at dividend strategies, and you alluded to this, which I'm glad you did, a distribution yield is not indicative of what type of return you're going to get, right? You always want to look at both the yield, the dividends you're getting, as well as the price, and make sure that the total return of the fund, again, meets your investor objectives, as opposed to just getting a high dividend and you're watching your net asset value, bleed over time.
Right. So, I always kind of warn, investors, hey, a lot of these high yielding funds, you have to really be careful of NAV erosion. I'm talking about the ones that are claiming they can, give over a 75% yield or something. Obviously SVOL been around for almost 3 years now. Its share price has slightly went down. I know you kind of touched a little bit about the NAV, and how can it kind of go back up? Is it if you guys distribute a little bit less in income?
Well, by structure, so by fund structure, when we trade the VIX futures, we have to pay them out at some point during the year, pay out the income, right? So it's not exactly like a REIT, right, where REIT has to pay out, I think, 90% of its income throughout the year, but it's similar to that, and we structured the fund that way so that we didn't have to issue a K-1 tax form, right? So with that said, when you get this income, right, whether we pay it out this month or throughout the next 7 months or whatever's left in the year, it has to come out of the fund. And so we don't expect the price could modestly appreciate, but I don't expect it, and we don't expect it to be a whoops, I gotta get special effects here. The thumbs down. We don't expect the price to meaningfully appreciate, right? Just because of the structure of how we have to pay out income. So, does that answer the question?
Yeah, I think there are, as you said, there is that kind of possibility with those options. So, Eric, our next question comes from this is another user question from Stockpile. He asked, how do you anticipate any changes? Do you anticipate any changes in the expense ratio? Then can you also kind of talk a little bit about what that expense ratio consists of? Because I think the one that's listed could be a little misleading, just because there's some expenses that you're kind of required to put attached to that number.
Yeah, I'm glad you asked that. So we have a management fee of 50 basis points or 0.5%, and that is disclosed on the website and has been consistent from day one. Last year, as many investors noticed, obviously, the other expenses line item increased quite a bit, right? Went from, I believe, 16 basis points to 66 basis points. And this is a function of us using what's called repo, which is the ability to lend our cash or our treasury bills out overnight. And so you can do this for a few reasons. You can either do it for additional yield, or you can do it for collateral management when you're trading VIX futures. And we've done it for both, right? But I would say primarily for additional yield. If you go back and look at our annual statements, you'll notice that there is a line item for SVOL where it shows interest income, and then there's also interest expense, right? And so the interest expense is what we're showing in this other expense line item. Unfortunately, we can't show the interest income. It just there's no reporting section for it here, and it's not again, it's just not how we would be reporting from an SEC perspective. So over time, and I've definitely in working with the portfolio manager Shailesh Gupta, I've been very vocal about minimizing the use of that repo facility so that we can then eventually reduce or drop that stated other expense publicly. And so we're constantly, as we go through each fund year, and we look at what the expenses are, how the portfolio management has adapted, if it has adapted at all, we then are able to say, okay, but we can potentially modify or reduce that expense ratio based on our use of the interest or the repo facility, or the other way around, right? If Shailesh decides that it makes more sense to use that facility, then he can certainly do so. And again, I would steer him away from that given the optics of it, but at the end of the day, we want a good total return fund, and he's got the mandate to do that.
Yeah, no, totally understandable. In the comments, I think what scares some people away is that I think it's listed as 1.16 basis points expense ratio, but as you mentioned, only about 50 of those basis points is actually going toward like the actual management fees. The other is kind of going toward those repurchase agreements just to kind of help the fund obtain its objectives and strategy. We have another user question here from Mose. They're wondering, are you guys ever coming to the European markets?
It's a great question. We get a lot of interest there, and I'm glad you brought that up. Nothing we can announce at this time, but we are always exploring our options for international distribution. Sometimes, I've come across European and foreign investors who are able to purchase our funds depending on their either country, broker, whatever. The situation is challenging for me because, there's so many different domiciles, right, to navigate. But I do know of some people who do own it internationally. But as far as us listing in, say, Europe or offering like a UCITS product or being registered there, we're exploring that option and hope to, again, in the future, have something to present to you.
Okay, so yeah, we'll just have to stay tuned for that one. Kind of the inflation data came out today. It wasn't too hot. How would you say interest rates would impact this fund?
So directly, our cash collateral is really going to be the thing that is most impacted by interest rates, right? And primarily treasury bill rates, right? So the front end of the yield curve. And so if you think now, let's say you can get 5.5% on 1 to 3 month treasury bills, right? If, let's say, the Fed were to turn around and cut or raise rates, right, then the yield on short-term cash or short-term bills would change, right? And so, that's now a fairly meaningful part of the total return of the fund. So, take that as you will. As far as the primary return drivers, right, via short and fixed futures, and then some of the fixed income exposure that we have, both added duration, right? So we have extended our duration or rate sensitivity in recent months in the portfolio from just treasury bills to now short-term investment grade bonds. But also we have implemented some volatility harvesting on fixed income, just given where the bond volatility index is right now, right? And so as equity vol has been fairly cheap, right? We've seen VIX hit multi-year lows, not quite today, right, given the market sell-off, but over the last couple of weeks, we've been in a really low VIX environment, and past couple of months, really. Bond volatility remains fairly elevated on a historical basis. So we've looked at that and said, hey, you generally want to be selling vol when it's rich. If we're a little bit less comfortable with the equity vol piece, we might be more comfortable taking some fixed income vol, right? And so, again, going back to your question then, if realized vol in the fixed income market, i.e. rates move much more than our option positions, effectively account for, you can see some pressure there. And then as you add duration in a portfolio, right, as you add, rate sensitivity, if rates go up, you'll feel a little bit of pressure there. And then conversely, as rates come down, you would feel a little bit of a tailwind, right? So yeah, to answer your question, then if rates come down, it's kind of a mixed bag. I think for us, we want to build a portfolio that's fairly robust across different market environments, and so rates don't have a huge impact on it overall.
Okay. No, I mean, that's good to hear. I mean, it sounds like interest rates may be paused for quite some time. So kind of heading into our penultimate question here. So, lots of different demographics watch this channel, right? I'm in my 20s, but I also have lots of viewers who are in their 60s, have multi-million-dollar portfolios. Who would you say simplifies investments, maybe specifically SVOL? Who are they typically designed for? Do you treat them kind of as a different asset class because they're not your kind of your common popular equity?
Yeah, I mean, SVOL is a unique beast, and it is, the irony is never lost on me that we're called Simplify, right? It is a complicated strategy. Conversations like this often, help, right? But there are always still, a little bit of ambiguities around things like this. I view SVOL as an equity income strategy. And so with that in mind, if you are an investor that is, invested in equity income, you should consider SVOL for a portion of that portfolio, right? And the reason I consider it equity income is you expect it to have a positive beta or a positive correlation to stocks or to the S&P 500. The degree to which, we correlate can vary, but typically it's going to be on the lower end, right? Right now we're running a beta of about 0.3 to the market. That can fluctuate, but effectively that's telling you it's a defensive equity income strategy. As far as, again, your individual goals, right? If you find it reasonable to be investing in equity income or really just like risk assets in general, I think SVOL can play a meaningful part in a portfolio. And one of the privileges of working here at Simplify and being a part of this journey is that the products that we build, are products that I use, right, and my family uses, that we use as employees, right? So we're excited to bring this stuff to market because we look and say, hey, nobody else is doing this kind of thing. We want that, right? So that's not investment advice, obviously, right? I got to put that disclaimer out there.
Yeah.
But I, as I mentioned earlier, like SVOL is one of my favorite funds, so I get really jazzed up about it. And like anything, it's got its weaknesses, but if you size appropriately, as you should size any investment, it can serve a major role in a portfolio.
Okay, awesome. So Eric, any final words, any Simplify news that you want to share before we call it a night?
No, Cody, this has been awesome. I really appreciate you having me on, and I want to thank your audience for putting up with me for some time. I know I can get a little rambly, but if anybody has any questions about the strategy, about what we do here at Simplify, I encourage you to reach out to me directly. My email address is eric, ERIC, .McArdle, MCARDLE, @simplify.us, or visit simplify.us and hit contact us. We really appreciate working with individual investors, and again, we build these solutions for you all. So anything we can do to support, please let us know.